So I focus on the interaction between policy and innovation with a particular focus on how government actions can stimulate innovation in low carbon energy technologies. And I like to say that my work kind of goes in two directions. Part of it is empirical, historical, looking at case studies, looking at previous data. And part of it is policy analysis, is forward-looking, is modeling, is considering alternatives among policy actions. And today, I'd like to talk briefly about four items. One is a framework for thinking about how policy can affect the innovation process. Then I'd like to talk about two challenges to interacting with that process. And then finally conclude with a list of items for future research that some colleagues and I have recently put together. So just to begin, sorry, Eric, how do I advance? Is it this?
Yeah.
Okay, great. So just a couple of things to have in mind are kind of several properties of innovation that I won't go into now, but just to make the case that there are certain properties of innovation that generate surprise or serendipity involved. There's a lack of predictability, and these have to do with the items on the left-hand column then. And then there's other drivers of kind of smoothness and gradualness in the innovation system. And I think we're often trying to make a comparison between radical and incremental innovation. And really what we're thinking about in terms of the outcome of a system is a system that includes emergent characteristics, including several of the items on the left, and a system that has inertia and smoothness and slowness to it, which is on the right, especially for energy technologies. So those are just items to keep in mind as going forward. So I'd like to just introduce this simple model of how policy can affect the innovation process. And I'd like to think of it as kind of a meso model, like in between the richness and the full explanation that we had yesterday when we were thinking about innovation systems, in between that rich description and a much more parsimonious, narrow description that has to do with maybe an economic viewpoint, which is much more about identifying market failures precisely and then using price signals to address those market failures. So this is something in between the simple and the complex. And so it starts with this kind of old, almost ancient idea of the innovation process of going from the discovery of new knowledge, invention, the commercialization of that new knowledge and innovation, and then the adoption and diffusion of innovations, which in the end is really what matters. What makes this model more interesting than the model from 50 years ago is it includes this feedbacks in the process. So you can see these arrows going backwards. From market experience can inform new ways to adopt technologies and even identify new ways to look for new innovations, new patents, and things like that. So we've got this core innovation process, and sometimes you can map that to stages of the innovation process. This kind of works pretty well with governments thinking about basic research versus other parts of the innovation process. And then the next thing I like to do in terms of adding on to this is to think about interacting at two ends of the process. And so you can think about doing technology push, which is on the left side there, and demand pull on the right side there. And so let me just define those in a couple of minutes here. So we can think about technology push as Bill Gates is a big fan of technology push. So that mission innovation from 2 weeks ago is 100% technology push. So was the Manhattan Project. So was the Apollo project to land someone on the moon. Basically about science, marshaling science and engineering, big investment in R&D, trying to come up with new discoveries and new technologies. And the goal there, in terms of the government goal, is to increase the availability of knowledge. And there's no doubt that lots of knowledge was created by the Apollo project, by the Manhattan Project, and certainly would be by mission innovation for energy and climate. On the other side is demand pull, and this is working on the other end of the process. This is working on increasing the size of the market for new technology. So if you think about, well, I'll talk about some examples in a minute, but things like a feed-in tariff or subsidies for new technologies, that's all increasing the market for a new technology. So technology push is working on R&D, the science, the availability of new knowledge, and with demand pull, we're trying to increase the markets for those new technologies. In terms of the actors and incentives, this is what it means for private actors. So if you do technology push, if Bill Gates is successful in getting all these private investors to invest their billions of dollars, and importantly get governments also to invest maybe double their R&D or maybe more, what that does for private actors is it reduces the cost of innovation. They get access to new technologies, they get access to new knowledge, they get access to newly trained scientists and engineers that are smart about new materials or new ways of incorporating information into energy and whatever things are invested in that area. So in terms of incentives, you got lower cost of innovation. On the other side with demand pull, what it means for private actors is the payoffs to innovation are increased. And so it's not just about deploying technologies and trying to get some of the benefits of these cleaner technologies. It's about creating incentives so that private actors will invest in research, improve technologies, maybe get to scale, and with that, improve the performance of those technologies and maybe the cost of them over time as well. So be more specific about what this means on the left-hand side with technology push. The big one is research and development, but also tax credits for private sector to do research. Education is certainly a big part of technology push, was a big part of what came out of the Apollo project in the 1960s. Demonstration projects, I'll talk about that in a little bit, kind of a troubling one. And then knowledge networks, so finding ways to get people together to share knowledge, that's been really important. And actually the OECD probably plays a big role in that type of activity. And then on the other side, the big one for demand pull generally is intellectual property regulation. So giving investors a temporary monopoly, a 20-year monopoly on their patents so that they can charge higher prices for 20 years. That certainly retards the diffusion of innovation, but it creates strong incentives for invention. So there's a trade-off there. You could price externalities, so carbon pricing would do that. Subsidizing demand, that's been actually much more popular than pricing carbon. Government procurement, I think we heard about that yesterday. And then technology standards is another way to increase the market for a new technology. So that's what we have, technology push and demand pull. What is tricky there is to say a lot of the arguments there are which one should we do? Should we do Bill Gates and just invest and beef up our research and development? Or should we say we have the technologies we need and we really need to deploy them now because we're running out of time? The consensus seems to be from the kind of historical looking at what has worked in the past is that you need both. But that raises this important policy question is how to allocate, how to get the right mix of research, technology push, and then demand pull. So that's kind of a key policy challenge is that allocation. What I'd like to do now is talk about two other policy challenges that come out of thinking about innovation and government in this way. And so the first one is thinking about what we do when demand pull is fragile, when the incentives that come from demand pull policies are not fully credible. And then second, what happens with innovations or technologies that are in this intermediate stage, that are between technology push, the R&D stage, and the market stage, the commercialized, available technologies, the demand pull stage. And that includes a particular problem that I'll talk about in just a minute. So first, fragile demand pull. So here's the problem. If we're thinking about environmental technologies, energy technologies, climate change, there's this inherently long-term aspect to it. So CO2 that goes up in the atmosphere might stay up there for decades, if not a century. Capital stock that we build in the energy sector similarly will last for decades, maybe on the order of 50 years, 60 years. So what happens in terms of the payoffs to new inventions, to new innovations, is they depend on the future. They depend on expectations. And because so much of the attributes of these technologies are public goods, they depend not just on market expectations, but on policy expectations. And so those are crucial. And so the question then is what happens to actors, to investors, what happens to investment if expectations about future policy, that's not next year, but maybe in 5, 10 years, 20 years, what happens if those expectations include uncertainty? And it's particularly important if that uncertainty is not symmetric, but has some skew to it, which I think there's probably probably evidence to support that it actually is a skewed distribution in investors' heads. So do we need additional incentives? Let me just illustrate this with a little bit more detail. So first is the evidence that commitments we have so far are not fully credible. So this is a kind of a caricature of U.S. oil imports and 3 targets. And the first one you see in 1973 was made by President Nixon in Project Independence, to have the U.S. oil import independent by the end of the decade, by 1980. The thick black line is the historical record. And you can kind of see how we didn't even come close to meeting that target. Jimmy Carter made a similar target. We didn't meet that one either. And President Obama has made one as well, much less ambitious and a little closer to actually meeting it. But this just illustrates this evidence, and this is in a U.S. context. So one thing we did is looked at all the energy-related targets we could find that included a target of more than 5 years in the last 40 years. And we came up with 65 targets, and then we evaluated whether the targets were met or not. And depending on how you count, between 2/3 and 3/4 of the targets were met, and roughly 1/3 were not met. So there's reasons for investors to be suspicious about targets, even though I think they're probably more skeptical than they actually should be given the historical performance. So that's just to say that there's evidence that governments don't always meet the targets that they set. And in terms of what this implies for investors, for incentives, for actors, this is just a little anecdote. So I was interviewing venture capitalists in Silicon Valley, thinking of these people as kind of the most sophisticated investors in terms of assessing risk, of compiling portfolios of different investments, willing to tolerate lots of losers in order to find one, they call them unicorns now, but $1 billion payoff. And I thought they would have an interesting way of addressing policy risk. So I asked them how they include that in their models of potential investments. And I got this answer when I said, how do you value these benefits? And it's pretty clear. We said, we ignore it. What the government giveth, it can taketh away. So it really builds on this experience of the past of these targets not being credible. And really what they see, these investments that they're making, and some of them are in clean technology, but they're trying to pay off based on consumers valuing new information or valuing convenience or valuing green attributes, but they're not doing it because of policy. I think they're actually leaving something on the table here. But you can see that the most sophisticated investors in technology seem to be especially risk-averse when it comes to policy. And I saw this also, here's another anecdote from a European perspective of saying basically the same thing. So let me just talk for 1 minute here about why this actually matters, why these incentives matter, and why credibility matters. So here's one example of looking at, I think we had 2 or 3 mentions yesterday of solar photovoltaics getting cheaper. And so I've done some work on that, and the question is, why did solar get cheap? The full answer is it's a big combination of factors, but if you had to pick one, it has to do with expectations. And so let me just tell that story for a couple minutes. So here's the 80-year history and future of solar power, and this vertical axis here is in dollars per megawatt hour, and that's roughly today what a U.S. household consumes in electricity a month. So you can think about this as the cost of electricity from solar for a residential consumer per month for a U.S. household. So back in the 50s, it was pretty hard to afford $100,000 per month in electricity, but one consumer could do that, and that was the U.S. Space program. So we had satellites that did that, and then over time, the cost of solar came down. This is a logarithmic scale. So those are big reductions from the 1957 satellite launch to 2007, where this one ends. If we zoom in on that last period, we're starting to see solar that's cheap enough that it could replace a roofing material. So let's zoom in on that. So no more logarithmic scale. So we're going down from $1,000 per megawatt hour, $1,000 a month, down to about $400. And then put a couple of other data points up here. So that dashed line is U.S. retail electricity prices. So in a way, that's the target. Secretary Chu had this target in 2011 that by the end of the decade, we'd get down to about 6 cents per kilowatt hour, or $60 per megawatt hour. That's that diamond there. And then a few years ago, I was involved with a group doing expert elicitation. So trying to get expectations about future technologies out of experts' heads. So trying to get probability distributions out of their heads. And so we tried to do that, and we did that with about 200 experts. And you can see this is their estimates of the cost of solar power in 2030 from roughly 2010, 2011. That's their best guess, so mid-range estimate. Here are the best cases, and there are the worst cases there. And then let's put on the actual data for recently. So this is utility scale power in the US, so actually below the Secretary Chu target by 2012 there. And then if you put on the residential prices, those are higher, but also going down, and also some of them below US retail rates without subsidies there. So I guess there's a few points that you could make on this graph. I mean, one of the most interesting to me is this wide dispersion in prices, and that there's not one price of any of these technologies, that markets matter and lots of other things matter. But what I'd like to come back to is this issue of how this all happened and why the experts were wrong. And so partly the big reason is, how did this all happen, is economies of scale, that investors, people developing the technology were confident that there were markets for PV. They were willing to invest $500 million in a factory of that size there on the left there, and also willing to invest in automation. So instead of having a batch process, there are robots doing a lot of this work, and new machines got developed for them. All of that happened because there were expectations that there would be a market for this, and that these billions of dollars in investment in infrastructure and manufacturing would eventually pay off because there would be a market. And so this comes back to this issue of policy credibility. For some reason, and that story I think needs to be told, is what that reason is, there were expectations that there would be a market for PV, and it was not just the German feed-in tariff, but that was a big part of it, but similarly markets in Japan, in China, in Italy, and in California as well. So the point here is that expectations matter, and policy credibility is important. So some recent work I've been working on is trying to think of ways that you could address this, this issue of policy credibility. And I'm happy to talk more about that later. But I want to talk about one other challenge here, which is this issue of being at the stage between technology push and demand pull. And there's quite a few technologies that fit in this category. So if we're at this demonstration stage in the middle there, we've got this problem where the social returns are still high, but the private returns are low. Partly that has to do with probably 4 reasons, that there's spillovers, that any company can observe a demonstration program and figure out if it works or not just by watching. So why do they need to invest? Why not just wait and see? If everyone thinks that way, then you don't get investment. Typically, for some of these projects, you can't do it incrementally. You can't just build a small scale and then build the next one. You have to build $100, $500 million or euro projects. There's still high risk because it might not actually work. Building it at scale might reveal new problems that weren't apparent in the laboratory or at pilot stage. And coming back to this policy credibility issue, you're doing all this when the payoffs depend on policies and the policies are uncertain. And so that's led to this idea of the valley of death, where new promising technologies go to die because no one's willing to invest, the capital requirements are too large, it's still risky, and no one really knows what the market's going to be. So another metaphor that comes out of the valley of death is this one. I'll just illustrate it with this big demonstration effort in the 1970s to get the U.S. off of oil imports, which is the U.S. Synfuels Corporation under Jimmy Carter. About $5 billion spent with the goal of replacing about 1/3 of U.S. oil imports by 1992. And almost no usable fuel was produced from this $5 billion of investment. And part of the reason is get into some of those reasons. Probably the biggest reason is the crash in oil prices that happened just a few years as these plants were coming online. There's a similar story with a big effort a few years ago to address the rising cost of silicon as an input into solar PV. And so about $500 million in government loans were put in place for this company called Solindra. And for similar reasons, which I just showed you a couple of slides ago with the fall in the price of PV, this technology was no longer competitive. And so it's led to this idea of the technology pork barrel. And so we've got this valley of death where you have to somehow support technologies in the middle with large investments. But you've also got this historical record there where people think about these investments as just pork, and that's just a U.S. Metaphor for politicians doing favors for each other and distributing government revenues to their districts. And so that really flies in the face of maybe trying to focus and concentrate resources on a few projects and leads to this dispersion of resources. And in both of these cases had mismanagement and corruption involved as well. And so we've got this difficult discourse between valid reasons for being skeptical about these investments and other reasons that might just have to do with bad luck and that maybe these were just insurance policies against high oil prices or high silicon prices for solar. And so here's the systemic interpretation of the technology pork barrel, is that American political institutions introduce predictable, systematic biases to R&D programs so that on balance, government projects will be susceptible to performance underruns and cost overruns. And they didn't say this, but lots of other people have said this since, is that this shows that governments should not pick winners. And it really raises this issue of what to do if you face the valley of death, if you've got these issues of scale, of large spillovers, and uncertainty about the future, which altogether force a choice, force us to think about how we might achieve scale in our innovation portfolios. And so this idea is that government should stay out and not pick winners. If you really believe that, that puts a lot of technologies off the table. And so one thing we're trying to do in some current work right now is to think about joining these metaphors together and bridging the valley of death while avoiding the technology pork barrel. So looking at what factors does the case for government intervention rest, I mentioned some of those, and how to maximize the effectiveness of government support. And just to close, I'm just working on a paper with some colleagues, and I thought it would be relevant for this audience, is we're writing a paper on missing perspectives on energy innovation, especially focused on social science perspectives that are not included right now. So some of them are incentives in bureaucracies. What happens if government R&D allocation is done based on risk aversion and with principal agent problems and may not reflect the societal benefits that might be at stake? How do we maximize knowledge dissemination? So we talked about the intellectual property system being a strong way of creating new markets, but that also retards the dissemination of new technology, new knowledge. So how to advance that, how to work on international collaboration on technology and international cooperation. The credibility of policy targets I've mentioned. Public attitudes to novel technologies. So that's something that's not been in a lot of models, but partly explains why some technologies get adopted and why some technologies do not get adopted. Incorporating some of those ideas earlier in the innovation process could make these government investments more effective. Characterizing the social returns to innovation, that's a really difficult thing to do, but a lot of these technologies have strong co-benefits, have a broad set of benefits, and it's actually very rare to even look at studies of the returns with actual empirical measures of returns, but the ones that do probably need to take a broader look. And then finally is to think about why we're doing all this, and why we're doing this is to somehow improve human well-being, somehow to address some of the problems with especially our energy system. And so social science can help in clarifying that. But what we really need, I think, is to identify some metrics to see how well we're doing, to see if we're on the right path. So thank you.